Okay, cool. We got Tim Herriage calling in. We'll see if Tim agrees with me or not, because if he doesn't, he'll say so. Tim is the CEO of a number of companies. I've known him in the industry for a long time.
Hello, Tim.
What's up, Tim? It's Greg.
This is Greg.
It is. How you doing?
Good, man. How are you?
I'm doing good. I was just telling everybody that I think the first time you and I met, we were both in an audience at the same session, and neither one of us agreed with the speaker, but you stood up and told him so, and then kind of took over the session after that from the back row.
Well, I mean, that's not my intention here.
That's good.
No, I was digging what you were saying, then I made that comment on Noel's chat that I didn't agree with 50% leverage. I said leverage based on cash flow, and he said, well, call and give your 2 cents.
Good. Okay. So you don't agree with 50% leverage, which means on the first caller, I told her don't put all cash down, but put down 50% to be sort of real super conservative. You don't agree. Why?
I mean, to me, if you're buying the property as an investment to derive income, you should factor the income and really finance based off of DSCR, the debt service coverage ratio. Because there could be times with certain properties that you may need to put more than 50% down. There could be properties that, a 70, 80% leverage could be okay.
So to describe the debt service coverage ratio is the ratio of the rents against what your debt service is, and what number do you look for?
Yeah, I try to finance, so a lender will give you about 1.1 to 1.2 is really kind of the lowest they'll go. So they want to say after your maintenance, your management, your repairs, your taxes, and your insurance, basically, and any HOAs. So kind of all those fixed costs with operating a rental property, they'll loan you where your principal and interest has to be, your net income has to be 1.1 or 1.2 times the principal and interest.
Right. So just
go ahead.
No, so that's not a very big margin though. So if we just do the math on this thing and it winds up that it's $500 a month, you're getting $1,000 a month. You're paying all those expenses. You end up with $600 a month in income. They'll go 1.2, let's say, on the more conservative one. So they're saying that they want $720 in. No, they want the $600 to be 1.2% of what they're willing to spend, which is roughly. They'll give you a mortgage payment of $500 on a income of $600 a month.
That's right.
Okay.
That's right. Because they want. It's almost the same underwriting as if you were qualifying for a personal mortgage.
Right.
Right. They want to make sure that the income that you're working with, which is in this case the rental income, can pay for the debt that you're asking for. And so, kind of the way we look at it now is. And I used to be an LTV buyer, right? If I could get it a certain loan to value, I would buy. But now I'm really trying to be smarter than I used to be, I should say, and focus on really making sure that the cash flow from that property is going to be able to pay for that property.
Yeah, no doubt. And so tell everybody how many houses back of the napkin you have bought in your career, Tim.
1,500 or so.
Okay, that's the reason why I told people 50% down, because the level of sophistication that you've got going on with that many transactions is, I wouldn't recommend you put 50% down. I recommend that you have your own strategy, but we're actually, this is actually, as you know, we're presenting ourselves as something between a real estate company and a wealth management company. Someplace, the intersection of Charles Schwab and RE/MAX, right? So it's real estate we're in, but we're helping everyday people. We also want to help pros like you, but the larger part of the market we're trying to activate are everyday people who maybe own none and are going to buy their first, or they own 2 or 3, they want to buy 5. And so I'm giving ultra conservative advice because I don't want anybody coming after me. So we make it like really, really simple.
And I wish I'd had better advice before the first recession, right? Because we found ourselves way over leveraged based off the cash flow of the properties, and we had some interest rates adjust, and the cash flow wasn't able to absorb the rate adjustment. And I think that my thing is they ought to get really good advice, and from you guys, and you guys have brought on a lot of different services, and I think learning to forecast your cash flow is probably the key missing component in the real estate investment marketplace. People, well, as you know, Greg, when you talk to a landlord in Atlanta, they run their numbers differently than a landlord in Baltimore, and the landlord in Chicago runs it different on the north side versus the south side of Chicago.
Right.
And trying to really understand a good net operating income, I think will tell you a lot about how much money you should put down. Because it could be more, it could be less, and it may actually be a very bad, great example. I bought a house for 50% of its value last week in Allen, Texas, that I would have had to put another 50% down on to make it a good rental property.
Interesting.
Right? So that would have been a 75% of value down payment because the rental rates in that area were basically non-existent.
Right, and so that's one of the reasons why I also don't recommend that people who are relatively new at this get involved in buying things, or even, I'll rephrase, don't even look for deals. Don't even worry about deals, right? Like my view of the smartest way to do this, if you are not attending to it as a full-time job the way you are, is to basically take a much simpler accumulation play and buy things that are in as perfect condition as possible. I'm not sure if you heard my joke, but it's not even a joke, that when I change a baby, I get chafed because my hands are so soft. You don't. You've had your hands on a hammer before. I haven't. I'm not sure which end do you hold the hammer? Is it this end over here? I forget how these work.
It depends if you're left or right-handed.
But I'm showing right now on the investor marketplace on Renters Warehouse, we have this calculator. And we have the pleasure, I've been showing the charts of price appreciation, which almost nobody knows what the price appreciation rates are. I have no way of measuring it. We do. We're giving that away. We also have this calculator, and we're trying to help set a standard of a responsible way so that you're right. The guy in Atlanta, the guy in DC or Baltimore, they do it different ways, but there is a way to do it, and it's the institutional way is the one that we have always been involved in. So we're putting these calculators out so you can put in that information and see the way it changes your yield and your cash on cash. We have a mortgage modeler on there that you can play around with different assumptions and watch the way the mortgage modeling changes your equity and your cash flow going forward. So we're trying to create as many free tools as we can so that people can get from like first base to second or second to third on their real estate investment strategy, and maybe someday get real sophisticated and then then start doing some of the more stuff like you do.
And I love that, Greg, because one of the biggest mistakes I ever made was during the recession. We had to owner finance some of those houses that we were over leveraged in just to get out of them. And now you look 10 years later, we literally gave up billions of equity gain from the appreciation. And so one of the things that my wife and I do now that I tell people to do is the exact same thing you said. Buy for quality, not for deal, right? Buy the house that's been there for 50 years and has never had foundation work in Dallas,
right?
Because it's on good soil and has good drainage. Don't buy the house that is a pile of rubble, but hey, you can save 10%. Because at the end of the day, typically those interior lots, those nicer houses, they're going to appreciate more consistently. I won't say more, but more consistently.
Right.
And you'll have less maintenance. You'll have less vacancy. You'll attract better tenants. And all of that just leads to more consistent cash flow, which for me, my rental portfolio is my part-time gig, right? It's my retirement. And my flipping is my active day-in stuff. I think talking to the folks at Renters Warehouse is one of those things that I do all the time to find out what the vacancy percentages are running, what the maintenance percentages are running, right? What are the real turnover costs looking like these days? What do you think I can get on rent on this house? What do you think it would go up in appreciation? Because those are the real drivers towards whether you want to buy the house or not.
Yeah, I appreciate that. It's nice of you to say that you've got your finger on the pulse, but getting an opinion from a Renters Warehouse person is also good because they do have, they don't run their own business necessarily only, but they actually have their hand in a lot of other people and what their strategies are. And we really keep our finger on the pulse of what's happening so that we give good, solid advice and that people, it's a beautiful thing. And I know you get this because you had 2020 REI, which you taught a lot of investors in a seminar style venue on how to secure financial abundance with real estate. And I know you must get emails and phone calls on occasion, maybe even pretty regularly, with people who are saying, "Hey Tim, thank you. I took your class in 2011 or whatever. I took your advice." Do you get some of those?
Oh yeah, I mean, because I think you have to find someone that can give you advice from a position of experience and not theory.
Right.
And that's why I make it a point to reach out to folks like you. And last month I sent you a guy that called me and had a couple hundred houses in Dallas to sell, and I can't give him advice about that. I've never done that, but I know people that can. So I think you have to really focus more on experience than theory. And so the reason I say call someone like Renter's Warehouse for advice on property management numbers is, there's not a whole lot of other people that manage 22,000 houses, right?
Right.
Thanks, buddy.
All right. Thanks for calling. Take it easy, bud.